I think we're all stuck in this cycle, paying for things we can't afford, or just tired of paying for it. It's like no matter how hard you work, the bills never stop. And the truth is, families aren't just stressed, they're going broke. So let's talk about the biggest money traps that are quietly bankrupting families and how they sneak up on all of us. So here's the thing, being a homeowner or even renting right now feels so much heavier than it used to. You work hard, you try to save, you make a budget, and somehow it still doesn't stretch far enough. It's not just you, families everywhere are feeling it. The bills keep coming and they're getting bigger than ever. So let's talk about the ones that are really wearing people down. Right now, so many families are what you call house poor. That means the mortgage or rent is eating up almost everything they make. I'm talking 30, 40, sometimes even 50% of a family's income just to keep a roof over their head. And it's not just a few people, more than 18 million homeowners in the US fall in this category. Nearly half of them are severely burdened with the cost of living, spending nearly half of their paychecks on housing before they even get to utilities, groceries, or gas for their car. And here's where it gets ugly. Mortgage rates are skyrocketing. Adjustable rate loans are resetting higher. Property tax jump when the county reassess your home. And insurance premiums are spiking, especially in states like Florida. So even if your loan itself didn't change, the total monthly payment has exploded. I've seen family bought a new construction home at a reasonable payment, say $1,900 a month, only to get a letter the following year saying their payment has jumped $3,400. Why? Because the first year they were only taxed on the value of the land. Once the house is reassessed, the taxes can double or maybe even triple overnight. And that's the kind of fine print no one really explains to you until you're already locked in. And homeowners aren't just frustrated, they're exhausted. Some are seeing their mortgage jump $500, $700, sometimes even $1,000 a month.
But I don't care what no one says. A mortgage payment increasing by $1,500 is diabolical.
Well, I can't afford my house anymore. Not because I lost a job. I actually got a raise. My mortgage just went up by a lot. So they say, buy what you can afford, live within your means. So I did.
My mortgage is going up. I just got my escrow analysis and the numbers are off, I guess. The math is not mathing. They want more money from me. This has happened for the second time in a row. This is getting out of hand.
That's not a small adjustment. That's life-changing money. It's why so many people are saying I feel trapped. I thought owning was the dream, but right now it feels like the house owns me. For a lot of families, it's starting to turn into buyer's remorse. They hustle, work 2 jobs, stretch their budget to buy. And now they're realizing home ownership isn't just a mortgage payment. It's taxes, insurance, HOA hikes, and endless repairs stack on top. The truth, we've glamorized buying a home without actually talking about the hidden costs. And in today's economy, those hidden costs are pushing families to the edge. Okay, if mortgage didn't get you, this one will. Childcare. Childcare is a second mortgage for a lot of families. Here are some examples. Some families are spending $664 a week for an infant. That's about 10 hours a day. That's $35,000 a year for one child. And pre-K isn't cheap either. $521 a week. That's $28,000 a year. In many cities, $1,600 a month for a toddler is normal, and plenty are paying $2,600 to $3,000 a month for 2 kids. Some quotes are $4,400 a month for 2. Daily rates are up to $70 per kid, which adds up very fast. 2 kids and it's $140 a day. That's $35,000 a year if you're full time.
Real talk. We spent $23,715 on daycare last year. I'm a mom of 2. My husband and I both work full-time jobs, and daycare is our full-time childcare.
I spent almost $25,000 in childcare services on 2 children. This is a judgment-free zone, right? Because I feel like we're all spending this kind of money. Probably more. When we were preparing to have our 3rd baby and calculated the cost of adding another child into childcare, we were looking at about $35,000. US dollars. And we were both like, this is a lot.
I just got the email that every parent dreads, which is the annual tuition increase for daycare for this year. Now, it's January of 2026, and the increase will not go into effect until September of 2026. So they give us plenty of time, which is really great because not every center does this, but we do get about 6 months to prepare for this increase in cost.
And the kicker, prices go up every single year. Most centers raise tuition each fall by 10%, some 5 to 20%. Miss pickup by a minute, you could get a late fee about $2 a minute in a lot of places. And you don't even see prices until you do a tour. Waitlists are long, so you're pressured to make a decision really quick. This is why a lot of families say we just cannot afford more kids. Because it's not just diapers, it's $30,000 to $60,000 a year just for your kids in daycare. And unlike a mortgage, childcare is not going to build you any equity. That money is just gone. And then there's a decision to either work or stay home. It feels like you're working to afford daycare, and then daycare takes most of what you earn. And if you do decide to stay home to save the childcare bill, you do drop one income. And then the mortgage, taxes, and insurance still want their money. But then we have to consider the fact as well that providers aren't getting rich. It's tough, low-pay essential work, but families are still drowning under the bill. So when people say they're barely making it, this is what they mean. Housing takes the first bite, childcare take the rest, and now add cars, insurance, and taxes on top. Let's talk about those next. All right, let's step into the driveway for a sec because this is the bill nobody plans for, the car. Most families need two just to make life work, and the payments, they are wild right now. I'm hearing people paying $600, $800, even $1,000 a month per car. Some folks are out here dropping $1,500, $1,600, even $2,000 a month on a single vehicle. Luxury dealers are seeing $3,000 to $4,000 a month payment like it's the norm. And that number on the window sticker, that's only the start. Add insurance, which has jumped hard in the last 4 years. Gas, repairs, tires, oil changes. Suddenly, it feels like another mortgage sitting in your driveway. For a lot of families, cars are the line between saving and falling behind. And here are some of the reasons why it's happening. High interest rates and long-term loans. You know, those loans that go on from 72 months to 84 months, the ones that drags on for years. And dealers, they'll pack on extra. Some people will drive off the lot at 14% APR without even realizing it. And then there's bad credit, big down payments, and huge monthly notes. And vehicles are pricey. Many SUVs are now $50,000 or more with tech that's expensive to fix. If you're wondering why your money is tight and you're doing everything right, look at your driveway. 2 cars between $700 to $900 each, plus insurance and gas. That is $2,000 to $2,500 a month before you even leave for work. I am not an anti-car. Life requires them. I'm anti-car payment that hijacks your budget. If you're shopping right now, just a gut check, the payment that feels okay at the dealership might not feel so okay when it's stacked on top of a mortgage, your HOA, childcare, and everything else that you have to pay for. All right, let's keep going because the bills don't stop at the curb. Next up is the ones that hit you even when your house is paid off. Property taxes are that bill you cannot escape. Even if your mortgage is paid off, the tax bill still shows up every single year. And they're not just creeping up, they're jumping. I'm seeing families in places like Colorado, Texas, Florida, Georgia get hit with increases in just a few years. One homeowner outside of Atlanta said their property tax increased about 61% in just 6 years. Another family monthly mortgage jumped $500 in 1 year. Not because of a new loan, but because their insurance doubled and taxes went through the roof. Here's why this hurts so much. When counties reassess your home, your taxable value can spike. If your escrow didn't hold enough, your lender will raise next year's payment or ask for a lump sum. In fast-growing areas, it can feel like a second mortgage you never agreed to. It can feel unfair. You didn't get a raise, you didn't remodel, but your neighborhood got hotter, so you build it too. It feels like you're paying a penalty for just staying. There are some things you can do though. Read your assessments every year. If it looks high, protest and appeal it. It's simpler than you think. Bring your closing disclosures, comms, and pictures of defects. File exemptions you qualify for. Homestead, senior, veteran, disability. A homestead exemptions can meaningfully cut your taxable value. Keep up with deadlines. Most counties only let you appeal around spring or summer, so if you miss that window, you will have to wait until next year. Budget for increases. Even $50 to $100 a month set aside beats a surprise shortage. If you're moving to different states, research the tax history by county. Some low tax states will still hit hard, especially when it comes to property taxes. Bottom line, taxes are rising fast, but you're not completely powerless. Check your assessments, appeal what's off, claim your exemptions, and plan for the jump before escrow shocks you. All right, take a deep breath because the next bill isn't optional either. And in some states, it's become a second mortgage all by itself. Homeowners insurance. Now let's talk about one of the most painful bills for homeowners right now, home insurance. Especially here in states like Florida, it's become a full-blown crisis. Some families are opening their renewal letter and seeing their premiums double, sometimes triple in just 2 or 3 years. I've seen people monthly mortgage go up $400 to $500 overnight because insurance and taxes got added on top. And here's the thing, you don't really get to opt out. If you've got a mortgage, your lender requires coverage. And even if you own your home outright, going without insurance is very risky. You can be one storm, one fire, one flood away from losing everything. That's why so many families feel trapped. Either you pay sky-high premiums or you live without a safety net. But why is this happening? A couple big reasons. Severe weather is hitting harder and more often. Hurricanes, wildfires, tornadoes, flooding. It's not just coastal states anymore. And insurance companies are paying out billions year after year. In 2023, 18 of the top 20 insurers in the US were losing money on homeowners policy. They were paying more in claims than they were collecting in premiums. And because repairs costs are higher, material, labor, even something as repairing a roof, it all costs more to rebuild. The result? Carriers raised rates, pulled out of some states, or stopped writing new policies altogether. Places like Florida, Louisiana, California, a lot of major insurers have already left. That leaves families scrambling for coverage from smaller companies or state-run last resort programs, which often cost even more. And it's not just storm states. Premiums are climbing in places like Michigan, Utah, and Maine because of extreme weather and wildfire risk. Even areas once thought safe aren't immune anymore. So what does this mean for families? For many, insurance has become a second mortgage. You bought your home thinking you could manage the payment. But now the add-ons, insurance, taxes make the monthly cost feels impossible. If you're in this situation, a couple of tips. Shop around every year. Don't just auto renew. Rates can vary widely between providers. Raise deductibles carefully if you've got the savings to cover an emergency. Look for community programs. Some counties or states do have relief, especially for seniors or veterans. Preventive maintenance matters more now than ever. A well-kept home is less risky and sometimes it will get you a better rate. But let's be honest, even with those steps, this is still a massive issue. For millions of homeowners, insurance is the bill that could push them over the edge. And if you thought that was rough, wait until you hear about the next one. Because HOA fees are quietly climbing. And for a lot of families, it feels like paying rent on a home you already own. So now we're going to talk about America's biggest troublemaker, HOAs. What started as we'll mow the grass and keep the pool clean has turned into a bill that can rival a car payment or a second mortgage. I'm seeing people who moved in at $300 to $400 a month are now paying $900 to $1,200 a month for their HOA. One owner said their condo fee went from $400 to $2,000 a month with no visible upgrades. Another saw their fees jump 55% in 1 year. And that's before the special assessments. You know, like an extra $500 a month for 7 months to waterproof the crawl spaces. But why the spike though? A few big things. One is insurance shock. Some communities had their master policies spike up and that got passed on to owners. Another is safety reserve rules. A lot of condos now have to keep a much bigger reserve for repairs, which again is billed to homeowners. And then there's aging buildings. If the reserves were underfunded for years, today's owners are the ones who are going to pick up the tab. And the kicker, you don't get much of a say. If the board votes to raise dues or add an assessment, you're paying it. Period. That's money that could have gone to groceries, your savings, or catch up on your mortgage. And it's not just the money, it's the micromanagement. A violation for grass over 3 inches. Fines for a garage door left open. And in another community, fined if the garage door doesn't stay open all day. Letters over a blue front door that wasn't the right blue. And then there's the lien they can put on your home. And even pursue foreclosure over unpaid dues or fines. Some folks are also dealing with paperwork fees just to sell their house. Special assessments that make units hard to sell. And in the worst case, Mismanagement that only came to light because the owners required an audit. If you're already in an HOA and the bills are rising, just here are a few tips to help your sanity. Go over their budget. They should be able to send you a copy of it. Ask about repairs. How are they going to be funded? Ask about the master insurance. Who's the carrier? When does it renew? Is it increasing anytime soon? Show up to meetings or organize with your neighbors to push for transparency. Know the appeal routes for violations. Always ask for photos and cite the exact bylaw. Bottom line, some HOAs are great. They're well run and worth the fee. But plenty of families are being crushed by dues that skyrocket long after closing. If your payment felt fine when you moved in, but now you feel like you're paying rent on a home you already own, it's not your imagination. All right, deep breath again. Because when the monthly squeeze hits, a lot of families are bridging the gap with credit cards and loans. Let's talk about debt next and how the interest alone can quietly drain your budget. Here's the silent stress. Debt. A lot of families aren't splurging, they're swiping to survive. Groceries, gas. And with interest rates where they are, carrying a balance is brutal. Credit cards don't feel like real money in the moment. So it's easy to swipe no and deal with it later. But then you get a statement with 20 to 30% APR and that minimum payment trap that keeps you on a treadmill for years. $1,000 purchase can turn into thousands of dollars when interest starts piling on. Buy now, pay later is everywhere. Shoes, small appliances, clothes, even takeout. Delivered to your door today and payments get split into easy chunks tomorrow. It feels harmless, but most people stack buy now, pay later on top of credit cards. So you're not necessarily replacing debt, you're layering it. If you miss a payment, you will have late fees. Do it a few times and your budget goes out the window. Here's what this could look like in everyday life. Say you're already tied for mortgage, childcare, car, HOA. A couple of split it into 4, buys a small emergency on the card, and boom, your minimum jumps. Next month, you're short again, so you swipe to cover the gap. And that's how people feel stuck even when they're working nonstop. I'm not saying never use credit. I'm saying do not let it quietly own you. Here are some quick moves that can actually help. Pick one card and attack it first. Highest interest or smallest balance for momentum. Automate a fixed payment above the minimum. Press pause on buy now, pay later until you're ahead. If you must use it, keep it to one active plan max. Call your credit card company and ask for a lower APR or a hardship plan. You would be surprised how often they say yes. Set a weekly cash cap for groceries and gas. If you've got multiple balances, consider a 0% promo transfer. Only if you'll pay it off before the clock runs out. And you won't be spending any more money on the old card. Debt doesn't just eat your money, it eats your peace of mind. And when you're juggling everything else that we have talked about, the peace is priceless. All right, so the next big hit to your budget is the one that shows up with no warning and can wipe out your savings in a single day. Home maintenance and repairs. Now, here's the one that sneaks up and hits the hardest: repairs. A roof replacement, a busted AC, a plumbing emergency. These are not little fixes. They're the kind of bills that can wipe out your savings in a single shot. And here's the tough part. In 2025, the average homeowner is paying over $6,500 a year just to keep their house running. That's things like lawn care, HVAC service. Add it up, and that's more than $30,000 over 5 years. Money most families don't even budget for. But what's driving it? It's a mixture of inflation, labor shortages, and aging homes. Almost half of US homes were built before 1980, which means they will need to be repaired. And materials still expensive. Even a simple job like installation or gutter repair costs way more now than it did a few years ago. And the danger is most of these issues show up without warning. 1 month you're barely covering the mortgage and groceries. Then next you're hit with a $7,000 roof repair or a $5,000 AC replacement. That's why this one is so dangerous, because it doesn't give you time to prepare. But what can you do? Here are a few simple habits that can stretch your dollar and protect your home. Check the basics. Clean your gutters, inspect your roofs, and seal cracks before they turn into bigger problems. Make sure you keep up with HVAC maintenance. Stay fire safe. Test your smoke detectors every few months. It sounds small, but it could save your home. Budget for what ifs. Even setting aside $100 to $200 a month can keep you from swiping a credit card when emergency hits. Here's the truth though, being proactive isn't always cheaper than being reactive. Just like taking care of your health, a little home maintenance will keep you from facing a financial emergency later. Alright, but maintenance isn't the only bill that keeps families up at night. The next one doesn't come from your house falling apart. It comes from the cost of staying healthy in a system that's supposed to care for you. It might not be tied directly to your home, but let's be real. If your healthcare cost spins out of control, it will affect if you can even keep your home. Right now, the average cost of healthcare for a family is pushing $35,000 a year. That's premiums, deductibles, co-pays, and those surprise bills that always seem to show up at the worst time. And here's what's coming. Experts say Affordable Care Act premiums could jump another 15% in 2026. Why? A mix of higher hospital costs, rising prescription drug prices, and federal subsidies from COVID set to expire. Those subsidies have been covering a big chunk of people's monthly bills. And once they're gone, families could see their out-of-pocket premium rise by 75% or more. So what does this mean for us? Millions of people may be forced to drop coverage entirely, not because they want to, but because they simply cannot afford it anymore. And that leaves families with impossible choices. Pay for treatment or pay your mortgage. And that's the kind of stress that's keeping people up at night. Because when healthcare becomes unaffordable, it's not just your health at risk. It's your home, your savings, and your peace of mind. So here's the big picture. It's never just one bill, it's the pileup. Mortgage, childcare, cars, taxes, HOAs, debt, home repairs, even healthcare. And when it all stacks together, families are doing everything right and still feel like they're drowning. But here's the hope. You're not alone in this. Talking about it is the first step, and you'll be surprised how many homeowners are facing the same struggles right now. And in the videos ahead, I'll be sharing not just problems and practical ways families are fighting back, saving money, and finding relief without losing their homes. Come to me, all you are weary and burdened, and I will give you rest. Matthew 11:28. Even when the numbers don't add up, there is still a God who cares about your needs. He cares about your home, your family, your future, so don't lose sight of that. So here's what I want to know. Which expense do you feel weighs heaviest on your family right now? Drop your answers in the comments. And if this video hit home for you, tap the subscribe button and share it with someone else who needs to hear it. There is still a lot more that we need to talk about when it comes to owning a home, and I don't want you to miss it.